Welcome back. Earlier today, we had a Federal Reserve summit at Jackson Hole, Wyoming. Chairman Powell spoke for quite a while, and he said a number of things, including the following. The central bank is prepared to raise rates further as it continues its fight to bring inflation back to its 2% targets. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident inflation is moving sustainably down towards our objective. He said 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably towards our goal. This is the CPI year over year. The black line is the Federal Reserve target of 2%. So we can see while we were at, I think, 8.9% on a year over year basis last year, and we have come down a lot, we're a little bit above 3% at this point, and it's still above 2%. And that is Fed Chairman Powell's target to bring us down to 2%. To accomplish that, they're going to continue to raise interest rates. He says we can't yet know the extent to which these lower readings will continue, where underlying inflation will settle over coming quarters. 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. Core inflation, core CPI in this case, year over year, is the inflation, that basket of goods and services that represents the economy, excluding food and energy. Food and energy are considered more volatile components of inflation. So you take out food, you take out energy, you have everything else, computers and washing machines and that kind of stuff. And that is still well above their 2% target. We can see here the most recent reading was near the 5% level, actually. Core CPI. And what he's saying is that, look, the past couple months we've seen declines. That is encouraging, but that's not enough to build on yet. Monetary policy will likely play an increasingly important role in bringing inflation down to 2% as pandemic-related distortions in the economy ease. This is a federal funds rate in blue, and that's a CPI year over year. And we can see very clearly during that period of time, post-COVID crisis, we saw very low interest rates and a lot of stimulus, and that sent CPI through the roof. And then the Federal Reserve says, well, we have to start raising interest rates. Well, according to the chairman, we're still on the path to raise interest rates. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. Now, we also look at inflation in terms of the PCE, the personal consumption expenditure. Again, these are year over year figures. The blue line is PCE. The red line is core PCE, again, excluding food and energy. It's a different way to look at inflation. There's lots of differences between PCE and CPI, but just so you know, one of the biggest differences is that PCE allows for substitution, where if we can't afford a steak, maybe we'll buy some chicken. And, the PC allows for the substitution. There's a lot of other things, a lot of government programs, I believe, are more accurately reflected through CPI and not PCE. So there are nuances, but nevertheless, we see PCE is down, core PCE is down. Core PCE is above personal consumption expenditure in the same way that core CPI is still above CPI. So excluding food and energy are down more than other measures of inflation. But either way you look at it, inflation is still too high. Well, this was the market's reaction to the Federal Reserve Chairman's statement today. This is a change in treasuries in basis points. The one-year treasury bond was up 5 basis points. 2 years up 5. 100 basis points, by the way, is 1 percentage point. So we're up 5% of 1% today, which is not a big move. 5%, 5 basis points on the 5 year. We've seen the greatest amount of growth in recent times in the medium and longer term maturity bonds. This is where current US Treasuries stand right now. Short term bonds, 1 month note, 2 month note at 5.56, 5.53. The 6 month is at a 5.61. Now, of course, we have an inverted yield curve where the short-term maturities pay a higher yield than the longer term. But what we've seen is a tremendous growth, an increase in the yields. The 10-year, I know it's lower at 4.25, but that's actually a very, very high. That's a multi-year high on the 10-year. This is the 1 month percentage change in terms of yield on the treasuries. In 1 month, the 10-year bond, that yield is up 7%. The 7-year is up also around 7% as well. So we see over the past month, what's moving in the bond market? It's the long-term maturities that are going up. Now, this is a 10-year in purple, and that's the S&P 500 in white. And as the S&P 500 over the past month, this is from July 18th through present day, so about 5 weeks. Stock market's been weak for 5 weeks, and the 10 year's been strong. The 10 year's moving up in anticipation that maybe we're going to have higher interest rates longer into the future, maybe anticipation that the economy is not going to be as bad as what we thought it was at one point, and we see this from a different point of view here. The 10-year bond is a blue line. The red line is a 1-year bond. We have an inverted yield curve. The red is above the blue, but the gap between these two is decreasing. We had a very large inverted bond market over here at 150 basis points at one point, 5% versus 350. That's much shorter now. And a lot of analysts are anticipating that the blue line eventually is going to go up, that it'll cross above the 1 year. Well, the federal funds futures also reacted to today's summit. The red bubbles represent the chances, according to the Fed funds futures, that the interest rates will not be raised. They will remain at 5.25 to 5.50 in the next meeting in September. The economic events below show us what these changes coincide with. We had a 90% chance the Federal Reserve was not going to raise interest rates around the time the Federal Reserve, just before the Fed minutes from the last meeting were released, following inflation numbers, CPI, PPI, following the wholesale inventories. Well, that 90% chance has now fallen down to 80.5% chance. We had a 10% chance the Federal Reserve was going to raise rates in September from 550 to 575. So it's always in a range, 525 to 550. If they raise rates, it'll be 550 to 575 range. Well, we were at a 10% chance of a Fed hike. It's now a 19.5% chance. So again, still the odds are Federal Reserve will not raise rates, but the trend is starting to develop that we're leaning a little bit more towards Fed hike. So to sum up, we have the Jackson Hole Federal Reserve meeting, and I think it's very clear. Federal Reserve has a 2% target. That's not changing. The tool they're going to use is monetary policy, meaning raising interest rates. That's not going to change. And they're going to be, of course, very data driven. They're going to look at inflation numbers. They're going to look at, jobs numbers. And as long as the jobs numbers, as long as the employment situation in the U.S. does not fall apart, and as long as inflation remains stubbornly above 2%, we can expect higher interest rates. How that translates into the stock market? Well, stocks don't like high interest rates. Stock market has been resilient, but over the past 5 weeks, it looks like maybe not impervious to all of these Fed hikes. So it'll be very interesting to see. And of course, we're going to be looking very much forward to the next piece of data that will indicate the likelihood the Federal Reserve will raise interest rates based on inflation, jobs, retail sales, and all that other good stuff. We hope this has been helpful. We look forward to seeing you back soon.